So we want to think about why complex assets or complex strategies appear to exhibit the following three things. The first is elevated alpha or persistently high excess returns. The second is high Sharpe ratios, so that's returns adjusted for risk or relative to risk. And the third is, despite having these attractive pricing features, these complex assets or strategies have very low participation. So if you want to have some specific paper in mind, you can think of the Duarte, Longstaff, and Yu paper. Is fixed income arbitrage picking up nickels under a steamroller? And what they show in that paper is they sort of rank fixed income arbitrage strategies from most complex mortgage-backed securities to least complex, which would be yield swap arbitrage. And they show that the mortgage-backed security strategy has the highest alpha, best risk returns trade-off. So the question is, if these complex assets or strategies have such attractive risk return features, why don't we all take all of our assets out of liquid equities and put them in these complex strategies? Why is participation so low despite free entry? So we're going to provide a rational model in which complex assets expose investors to idiosyncratic risk. Expertise is going to imply that some investors have a better risk-return trade-off than others. And that's going to mean that when you look out at a market-level Sharpe ratio, the individual Sharpe ratio is going to differ from the market Sharpe ratio. And sort of this risk-bearing capacity of more expert investors is going to act like an excess capacity-like barrier to entry for investors with less expertise. I'll get right into the model. We're going to think about a continuum of investors with constant relative risk aversion preferences over consumption. They're going to be characterized by their level of expertise, which we're going to draw from a fixed distribution with PDF lambda x. So that's going to be fixed for each agent over time. Then each agent's also going to have some wealth, which will evolve stochastically as a function of their savings consumption choice, their portfolio choice, and then the return shocks. Every investor will have access potentially to two technologies, a riskless technology that's in perfectly elastic supply and has an exogenous rate of return RF. If they decide to participate, they'll also have access to a complex risky asset with returns described there, where excess returns are follow a process with a drift that's equal to a common market clearing alpha. So we all invest in this complex asset or strategy. We earn a common alpha. There's some spread that we earn. But we all, because this asset is complex, to harvest that alpha, we actually have to come up with our own model, our own implementation or hedging strategy. And because of that, every strategy for this complex asset is actually going to be different. So that last shock is going to be an idiosyncratic shock that you get from your specific implementation strategy. And the volatility of that specific shock is going to be decreasing in your level of expertise. We're going to have participation, entry, and maintenance costs, and that's going to be what keeps everyone from participating. So intuitively, we can already see that it's going to be more likely that you participate if you have a higher level of expertise. So I'll talk about a few different motivations for this return process. We have a specific one in the appendix of the paper, which is via long-short positions or tracking portfolios. So if you want to think about there's some underlying asset, like a mortgage-backed securities, and you want to harvest the alpha in mortgage-backed securities. But to do that, you don't want to take on all the risk in mortgage-backed securities. You know you can hedge out some of it via a short position in a tracking portfolio. So what you're going to do is you're going to take a long position in the underlying asset. You're going to take a short position in the tracking portfolio, but every tracking portfolio of every investor is going to be different. And in particular, the tracking portfolios of investors with more expertise are going to be superior to those with less expertise, in the sense that those superior tracking portfolios will eliminate more of the underlying risk. The return to the net asset given at the bottom then, if you take the relative contribution of the underlying risk versus the tracking portfolio idiosyncratic risk to zero, then you'll get the return process that we had at the beginning. So we really want to focus on the contribution of idiosyncratic risk when investing in complex asset markets. And this is actually a very old idea going back to Merton. It's been emphasized by Robin Greenwood in a nice case he has at Harvard about limits to arbitrage. Jeff Pontiff also has a paper where he says that idiosyncratic risk is really the #1 constraint faced by arbitrageurs. So we're building on those ideas. We also provide a specific micro foundation. So we need that idiosyncratic risk is priced Then when you have idiosyncratic risk, you have to limit reallocation. So we're going to build on the idea that managers have to be exposed to their own portfolio stream for moral hazard reasons. And then we're going to use these constant relative risk aversion preferences, as I mentioned yesterday, because it's been shown in the theoretical literature that when you have performance fees and you're trading off the upside from the performance fees with the downside of getting fired and losing the stream of future fees, that you actually act like a constant relative risk aversion investor. So we build on that. And then we'll study stationary equilibria, where alpha is constant, and we have some follow-up work where we think about slow-moving capital or time series dynamics. So like I said, you can either choose to be an expert and participate in the risky asset, or a non-expert, in which case you can only invest in the riskless asset. It's going to be more interesting, and we're going to focus on the class of investors that decide to participate in the risky asset. And this is their Bellman equation here. It's going to look like a very standard Merton problem. The only differences are going to be in the law of motion for wealth, and the return process. So in the law of motion for wealth, the first term that's different is you have this flow maintenance cost, so this cost of participating. And then the second difference is in the stochastic shock. The volatility of the stochastic shock is going to be investor specific. And then in the return process, again, the alpha is the common market clearing return so that the supply is equal to demand in aggregate, but the Brownian shock is your own specific shock from your own specific implementation strategy. Okay, and the volatility of that shock, of course, is decreasing in your expertise. Then the first policy for investors in this economy is going to be whether you participate or not. And there's going to be a threshold rule, like there are in these types of models, whereby you choose to be an expert and invest in the risky asset, pay the entry and maintenance cost if your expertise is above some threshold. That's going to basically mean that the return compensation that you get for your level of risk is high enough for you to pay those costs and participate. Then we're going to use the fact that we've set the problem up in such a way that our value functions will be homogeneous in wealth. And the portfolio choice, again, will look like it always does. And the only difference is going to be that the volatility is investor specific and decreasing with expertise. We'll look for a stationary equilibrium with the usual properties: investor optimality, market clearing, and the distribution being constant over time, so this constant alpha. And the only thing I want to point out here then, couple of things. For market clearing, we really want to think about risk-bearing capacity in this complex asset market. So there are two margins. We talked about this before. The extensive margin, which is the participation threshold. So in the integral on the right-hand side, you see that we're only integrating above a certain level of expertise. So that's the extensive margin of the total amount of wealth that will be allocated to this market. Then there's the intensive margin, which is the fraction of your assets that you allocate to the risky asset and the share of wealth across different expertise levels. So if you work with these firm dynamics literatures, there's a notion of efficiency, which is for a given endowment of capital, you'll produce more the more efficiently that capital is allocated, if you allocate more to the high productivity producers. There's the same kind of efficiency here. The more wealth is in the hands of the investors with higher levels of expertise, the more risk-bearing capacity there will be, and the lower will be the required alpha to clear the fixed supply. So we'll look for stationary distributions. This is the Kolmogorov forward equation, which is just to say this is how we get the wealth distribution in closed forms. Basically what it says is wealth is moving along. As I make my decisions, I choose my savings, I choose my portfolio choice, and I'm subject to shocks. A stationary equilibrium is one in which each individual investor is moving through the wealth distribution, conditional on expertise levels, but the aggregate distribution is staying the same. So technically, we're going to use wealth shares with a reflecting barrier. I won't talk about that too much. The main point is that the stationary distribution is going to be a mixture of Pareto distributions, one for each level of expertise. So a Pareto distribution is one with lots of low wealth investors and then a right tail of high wealth investors. And the Pareto distribution is going to be expertise specific, so different tails at different levels of expertise. So what we're doing here is we're combining IO, size distributions, with risk-bearing capacity at each level of expertise with kind of market clearing and then this market level risk return trade-off. How does this right tail, the fat tail of the wealth distribution, depend on a particular level of expertise? So you have a continuum at each level of expertise. The wealth distribution is Pareto, And in particular, when you vary expertise, the higher the level of expertise, beta is the tail parameter, so that's how fast the tail decays as you get to higher levels of wealth. That beta is going to be lower, so you're going to have less decay and a fatter tail for higher levels of expertise. This is very intuitive. The higher your expertise, the more you allocate to the risky asset. That's going to push you into the tail, both because your drift of wealth is going to be higher, and also because the volatility of your wealth is going to be higher from that higher allocation to the risky asset. So you're just more likely to end up in the tail. You get fatter tails at higher levels of the wealth distribution. So you have this natural force towards efficiency, more wealth in the hands of investors with more expertise. So then the question is going to be, how do you still have this really high alpha if you have this natural notion of efficiency? And the answer is going to be because it's only high enough to compensate the people who have the high enough expertise that compensates their risk-return trade-off. Now we're going to do comparative statics across markets. It's a stationary model, so we're not doing time series comparisons. You want to think about mortgage-backed securities versus yield curve arbitrage. Mortgage-backed securities, more complex, meaning it has higher fundamental volatility before expertise is applied. So you can think of this being just a downward shift in everybody's level of expertise is one way of thinking about it. So more complex asset, higher, exposes everyone to more risk. I think that's very intuitive. So the first result is an asset pricing result that just says the more fundamental risk, shift everyone's risk up, then demand for the risky asset's going to go down. To clear the fixed supply, the required return has to be higher. Alpha has to be higher. Second part, then, remember I emphasized at the beginning that individual Sharpe ratios are going to be different than the market Sharpe ratio. And now there's something interesting to think about, which is as fundamental volatility increases, who gets hurt the most? You have this distribution of expertise. When fundamental volatility increases, you have three cases. Either everyone's effective volatility increases by the same amount, or the effective volatility of the high expertise agents increases by more. It sort of hurts the incumbents more. Or what we're going to argue is the more natural case, actually the increase in volatility hurts the investors with more expertise by less. So that's sort of saying like more complex asset markets with higher underlying volatility actually also have higher returns to high expertise, and we think that's very natural. So we're going to focus on this case 3. So up to now, everything's been general in terms of the distribution of expertise and the functional form for effective volatility, but now we're going to focus on this case where when you get to a more complex asset with higher underlying risk, that actually hurts the lower expertise agents by more. And that's going to be the way that we get the lower participation combined with the higher market level Sharpe ratio. We're going to need that third case there, in particular for the decreased participation. And that's what we're going to talk about now. So I've highlighted, if you kind of are still recovering from lunch, you don't have to look at any of the equations, just focus on the yellow boxes. So we'll define this entry cutoff X lower bar. That's the expertise level above which you participate. And we're going to say that that cutoff increases or participation decreases. First thing we need is that case that I said, that when the fundamental volatility or complexity increases, that hurts high expertise agents a little less than it hurts low expertise agents. And then the second thing you need in this condition here is that you need that the highest elasticity, meaning the person who's hurt the most, which is going to be the person right at the threshold, that how much they suffer is different enough from the top. Because what you need for participation to decline is that the alpha, the resulting increase in alpha from the higher level of risk, does not compensate the people around the threshold, and in fact pushes some people above the threshold below. Because you have more risk, you're going to have a higher alpha, but the alpha is really going to compensate enough for the overall market, not necessarily those low expertise people at the bottom. So now we're going to have, with higher fundamental volatility, a lower fraction of people participating. Okay, so we already know that definitely as fundamental volatility increases, the alpha is going to increase. With this case of declining elasticities, you also have lower participation. Now the question is, what happens with the market level Sharpe ratio? Because we don't just care about the level of returns, we care about the level of returns relative to the risk in the market. So we're going to define, and for the purposes of the talk and actually the paper too, the equally weighted market Sharpe ratio. So now when everybody's Sharpe ratio is different, the Sharpe ratio sort of, you have to define what the market Sharpe ratio is. We use equally weighted. It's a much simpler expression. Value weighted is going to make everything actually a little easier for us, but be very complex in terms of expressions. So that equally weighted Sharpe ratio is just weighting by the population of expertise levels within the market what everybody's individual Sharpe ratio is. So it's sort of, remember, you kind of, if you're back to your first macroeconomics class, behind the veil when you're drawing your type, it's what type you would expect to get conditional on entry into the market. So that Sharpe ratio is going to be increasing with fundamental volatility if participation increases with fundamental volatility, but we think the other case is more interesting where participation decreases as assets get more complex. And for the Sharpe ratio to increase as participation decreases, you need a condition that's very similar to participation decreasing itself, which is that you need the people who are right around the threshold, you need their kind of low Sharpe ratio not to overwhelm the market Sharpe ratio, so that the market Sharpe ratio goes up. Either that, or you need that their elasticity is different enough so that the alpha has to compensate them. Okay, so two conditions that are very similar to the conditions that you need for participation to decline are also going to give you that the market equally weighted Sharpe ratio will increase. Okay, we have a numerical example. We're going to change volatility, fundamental volatility on the x-axis. If you start in the top left corner, as volatility increases in partial equilibrium, which is blue, demand is going to decrease. Then move to the right in red, the required return then in general equilibrium has to increase. The entry cutoff in blue in partial equilibrium is going to have to increase a lot as volatility goes up. Fewer people want to participate. But then as alpha goes up in general equilibrium, the red line, actually it goes up a little bit less. So the fraction of experts then is graphed on the right. It decreases a little less in general equilibrium because there's a little bit of alpha compensation as risk increases. And then at the bottom right, you see that Sharpe ratio increasing. So it's just a numerical illustration of our model generating what we think are these interesting facts about good alpha, juicy alpha, good Sharpe ratios, but really limited participation. Okay, so last thing we're going to do, the real benefit of coming up with a model that's sort of an industry equilibrium model of asset pricing is that now we can take these asset pricing results and we can relate them to things like the size distribution or market concentration. So what you're going to see on the left-hand side is the data, sort of the size distribution within a bunch of hedge fund categories, in particular the relative value categories, because those are the categories where you have this long short kind of thing that we had in our micro foundation. So if you, if you ran a regression, there are a few data points, but on average, the more complex asset markets are less concentrated. And so the question is, can our model also generate that less concentrated size distribution for more complex asset markets? It seems not obvious in the beginning because there's this natural force towards concentration. The efficiency argument, meaning that because I have higher expertise, I'm more likely to get wealthy and get a fatter tail, means you might expect the market to be more concentrated for more complex assets. But actually, that's only the intensive margin of participation. For those more complex asset markets where you have very little participation, you're already in the part of the distribution where the effective volatility isn't differing that much. So you get this less concentration in the model, too, we think, under natural conditions. So it's kind of just a nice ancillary result that we have. Okay, so I'm going to go ahead and conclude. We have provided a model where complex assets are strategies. We're kind of arguing that these complex assets are exactly ones where it's not just like you go long the asset. You actually need this implementation technology where you need a model that's going to expose you to idiosyncratic risk. I like this quote from Emmanuel Derman that says, if you're long your model, you're short volatility. And in particular, you're short your own model volatility. You're short your own model errors. We get these persistently elevated excess returns, high Sharpe ratios, but despite these nice features, we get low participation. And let me just say, relative to the literature in segmented markets, we have endogenous entry, And then we have this continual or general distribution of expertise. And then relative to the cash in the market pricing or intermediary asset pricing literature, we have this limited risk-bearing capacity, but it's not just the amount of wealth that matters, it's also this efficiency of the distribution.